Hey there, money-hungry viewers. Today we're diving into FNMA, otherwise known as Fannie Mae. Think of them as the giants behind your home loans. They don't hand you the cash directly, but they buy mortgages from banks. This frees up the banks to lend even more, keeping the whole housing market humming. Without FNMA, things would get messy. Banks would have less money to loan out, meaning fewer people could buy homes. That's bad news for everyone, not just aspiring homeowners. Remember, a healthy housing market helps the entire economy grow. FNMA is a publicly traded company, which means you can buy a piece of the action. That's right, you can own a tiny slice of this mortgage giant. But before you jump in head first, let's understand what makes FNMA's stock price go up and down. Stay tuned because after the break we're talking about the factors that make FNMA's stock dance. Welcome back, investors. Now, let's talk about what makes FNMA's stock tick. First up, we've got interest rates. Think of them as the cost of borrowing money. When interest rates are low, people refinance their mortgages to snag a better deal. This is good news for FNMA as they buy up those refinanced loans. Next, we've got the economy. When the economy is strong, people feel confident about buying homes. More home buying means more mortgages and, you guessed it, more business for FNMA. On the flip side, a weak economy can spell trouble, as fewer people buy homes. And let's not forget about government policies. The government can make changes that impact the housing market, which directly affects FNMA. They might tweak regulations or introduce new programs, all of which can impact FNMA's bottom line. So, we've got interest rates, the economy, and government policies, all playing tug-of-war with FNMA's stock price. It's a lot to keep track of, right? But don't worry, because up next we're talking about how analysts try to predict FNMA's future price. Stick around, folks. Alright, let's talk predictions. Analysts use fancy models and algorithms to try and figure out where FNMA's stock is headed. They look at all those factors we discussed, interest rates, the economy, government policies, and try to connect the dots. They also dig deep into FNMA's financials. How much profit are they making? Are they taking on too much risk? These are all crucial questions that can impact their stock price. But remember, folks, predictions are just educated guesses. The market is a fickle beast, and even the smartest analysts can get it wrong. That's why it's crucial to do your own research and understand the risks involved. Speaking of risks, in the next segment, we'll look at some real-world examples of how different events have impacted FNMA's stock. Don't touch that dial. Remember the housing crisis back in 2008? That was a wild ride for FNMA. The housing bubble burst, sending shockwaves through the entire financial system. FNMA, holding a mountain of bad mortgages, needed a massive government bailout. Their stock plummeted. But it wasn't all doom and gloom. In recent years, the housing market has recovered and FNMA has bounced back. Low interest rates fueled a refinancing boom, boosting their profits and sending their stock soaring. The takeaway? FNMA stock is sensitive to changes in the housing market and the broader economy. Understanding these factors is key to making informed investment decisions. So there you have it, folks. FNMA, the mortgage giant, plays a vital role in the housing market. Their stock price, influenced by a complex web of factors, presents both opportunities and risks for investors. Remember to do your homework, understand the risks, and as always, invest responsibly.